Hey everyone, Chad Pavel, CPA here. In this video, we're going to talk about how much money house flippers can really make. If you've been thinking about investing in real estate, you've probably heard of two very popular, tried and true methods of investing in real estate. Now, the first is fixing and flipping homes, where you'll actually buy a home, fix it, and then sell it for much more than you paid to buy it and fix it for. The second strategy is to actually buy and hold that investment, where you want to become a landlord, and you're going to acquire properties, some with tenants in them, some that need work, and ultimately build a portfolio of cash-producing, passive income real estate investments. And if you're not entirely sure which strategy is for you or how to get started or how much money you can make, in this video, we'll cover all of these things. First things first, we're just going to go over a quick summary of fix and flip versus buy and hold. We'll go through a couple of fix and flip examples, meaning how much money you need to spend to buy a property, improve it, and then what really is the basic profit potential for you. And then for those who decide to pursue a business flipping homes or buying, improving, and renting homes, what really are the business models and the income potential. And finally, a quick overview of how the taxes work. And taxes are drastically different between the fix and flipper who gets in and gets out of house deals very quickly and the buy and hold investor. So pay attention because this can save you or cost you a lot of money. If you're enjoying these videos, hit the subscribe button below so we can continue to bring you awesome content on how to make and keep more money. So first, let's talk about fix and flip real estate investing and what it really means. You can see here on the photo, basically what happens is a fix and flip investor will find and buy a property, and they might find it through the MLS. They might find a property through, personal or professional networking. They might use wholesalers or bird dogs to help them find properties. They might be off market or they might be listed on the MLS. Basically, you need to find a property that needs work, and then you're going to actually go and fix that property. And depending on the level of risk and your financial capacity, you might take on some light flips where you'll buy a small or medium-sized home that needs some cosmetic work, or you might choose to get into a business where you need to do very heavy rehabs, where you're going to buy homes that need a lot of work. They might even be uninhabitable, and you're going to put a ton of work into it to basically overhaul the entire house and make it saleable in the near future. Regardless of what your strategy is, the basic concept of fix and flip is you're going to buy a home, whether it's a single family, multifamily, even a farm or a piece of land. You're going to improve that property in any number of ways, and then you're ultimately going to sell that property, hopefully for much more than the cash you put in to buy and improve the property. And if you do that enough times and you are consistently generating a profit, then you've got yourself a really awesome, profitable, growing, sustainable business as a real estate fix and flipper. Now, there's another angle to fix and flip investing, and that is where you'll actually buy and hold. So rather than selling the home for a cash profit over and over again, you might choose to hold a couple or all of the properties and ultimately rent them out to tenants, collect cash flow, and enjoy the benefits of depreciation, passive income, and appreciation of the value of the home. And if you're wondering how to finance all of these fix and flip investments, you've got a number of different options. Of course, if you have the cash in your savings or retirement accounts, you can purchase the homes and fund the improvements right out of your own pocket. You can also consider a live-in flip, where you buy a home that you actually live in and improve it with, again, either your own cash or a conventional or 203k bank loan. There's other options, including hard money lenders or other private financing sources as well, from individuals, from maybe some banks, from family offices. And we've even seen plenty of real estate investors who use zero interest or low interest credit cards to fund all or a portion of the purchase price and the repairs. Regardless, there is plenty of capital out there, whether you're doing $50,000 rehabs or $10 million rehabs. There are definitely plenty of capital sources out there, ranging from equity and debt and low cost to high cost. So here's a typical example of a fix and flip scenario. You're going to buy a home for something like $100,000, and you might find some homes for under that. You might find some homes that are in the $300,000, $400,000, $500,000 range. Regardless of what the price really is, your goal is to make a profit. And so when you think about the money in versus the money out, the difference is going to be your cash profit. And also the speed with which you can get your money in, fix the property, get it listed, and sell it, and actually collect your proceeds plus your profit back. That's going to determine how quickly and how many properties you can flip in a given year. So in this scenario, you're going to buy this home for about $100,000. And let's say it's a pretty heavy flip in that you need to put $50,000 in to rehab the property to its former glory and make sure that you can sell it for much more than the cash you put into it. So that might mean you need to redo the kitchen, the roof, maybe there are some utilities that you need to fix and replace, the floors, the carpets, paint, bathrooms. That's a pretty heavy rehab. And if you can get it done for $50,000, that's pretty darn good. So once you've bought the home for $100,000, you've put $50,000 into it in repairs and holding costs, and let's say you put it on the market and then you're able to collect $200,000 in cash after all fees once you've actually sold the home. That means you've got a $50,000 profit on that property. So now when you think about it, if you can make $50,000 flipping a property and it doesn't take up every single hour of your day, you can probably go and do more and more rehabs. But it might be tough to maintain that $50,000 profit margin. You might find you're only going to make $20,000 or $30,000 if you do multiple flips. You might find that you just simply want to do higher end flips where you make no less than $100,000 on a flip. Regardless of what your strategy is, you need to find a way to make repeatable profits and build systems and build a team so that you can actually buy and flip a home without it taking over your life and without you losing any money. So first you need to think of your strategy. Do you want to do 3 or 4 flips a year at a medium to high profit margin? Or do you want to do 20 or 30 flips a year at a medium to lower profit margin? Second, you need to think about your exit plan. Do you want to buy, rehab, and sell homes and never see them again? Or do you want to buy, rehab, find good renters, and then refinance out your investment and collect passive cash flow rental income for years to come? You really need to figure out what's right for you. Do you basically want to be in the construction business where you're always having to go and buy and fix a property and then sell it? Or do you want to rehab homes simply so you can hold them and build a massive portfolio of rental properties that will help you retire early? Regardless, you need to find out what's right for you. The next piece is, where are you going to be investing? If you're in a super high-end market like greater New York City where I am, you're probably not going to find any properties for under $200,000 or $300,000 within a 50 square mile radius of New York City. And you might have no other option but to do mid to high-end flips simply because the purchase price and the cost of living is so high. Next, what is your financial capacity to raise money to do flips in the first place? If you have $50,000 or $100,000 in cash in the bank and a credit card or a personal line of credit, and you don't want to go raise money from outside investors, you're probably going to be limited to 1 or maybe 2 properties that you can be rehabbing at any given time. But if you have the capacity and interest in raising capital from equity investors or big-time private lenders or hard money lenders, then you might be able to do multiple flips at a time, or at the very least, multiple flips in any given year without disrupting your personal cash flow situation. The next, and I think most important aspect of your success as a fix and flip investor is your team. If you're home savvy and you want to go repair all of the properties yourself with a friend or a family member, once again, you're not going to have a whole lot of time or capacity to do any more than 1 and maybe 2 projects at a time. But if you have the interest to go and hire a team or a general contractor or a team of general contractors to help you with your fix and flips, you can do multiple flips at a time and definitely multiple flips in any given year. Next, do you want this to be your full-time job or maybe just a side gig? And finally, do you have your tax situation in order so that you're able to maximize the amount of cash flow you get out of your investments and maximize the amount of cash flow you plow back into your business so you can do more flips? Here's an example of a fix and flip investor who does a couple of flips in his or her first year, and they're making $50,000 per flip. If you do 3 flips, you'll make $50,000 per flip. Your net profit that year is going to be $150,000. That's not very shabby at all. And if you ask any real estate investor, that is pretty darn good, especially if it's your first year in business, doing something you've really never done before. And as you go on and do 6, 15, 25, and even 50 flips per year, you might find that you're willing to take a lower profit margin simply because you're becoming more efficient and you're trying to do more volume versus high-end hands-on flips. As long as you have a good team, a good financial strategy, and everything else is in order, you can knock out a lot of fix and flips in a year with the right finances and the right team. And you can definitely build a multiple 6- and 7-figure business by simply flipping homes. The other option is you can do fewer homes but higher end, where your minimum profit margin goal is $100,000 or $200,000. In this example, you can clearly make just as much, if not more money, doing fewer jobs with a higher profit potential. And again, it all depends where you're at physically, geographically, financially, personally, and what your goals and what your team's capacity are to do all of these jobs. And finally, if you want to simply flip a couple of homes per year and then actually hold those investments for real estate passive income cash flow where you're a landlord, you can also do that too and make a ton of money doing it. It's just that the strategy is completely different. You're going to still be buying and improving homes, but then you're going to have to go get tenants and rent out those homes and deal with all the things that a landlord has to deal with. Now, the good thing is you're going to enjoy all sorts of tax benefits like depreciation, all sorts of write-offs, and of course the home values will probably go up over time, which will increase your equity and increase your net worth. Either way, you can definitely make a full-time 6- and 7-figure living by either buying, fixing, and flipping homes or buying, fixing, and renting homes out to tenants. Here are the basic tax differences between fix and flip investors and buy and hold investors. Fix and flip investors are actually in the business of fixing and flipping homes. So they're not going to pay capital gains tax rates when they sell a home. The income and profits will actually be ordinary, just like a regular business, because they do this multiple times. And they're not buying homes for the purpose of letting them be an investment. They're buying homes so they can flip them and sell them, which makes it very much like a product business where you're buying, improving, and selling something, and after it's gone, it's gone. You're not trying to hold it for any sort of appreciation or investor type of benefits. Your revenues are quite literally the sale price of the homes, your cost, or all of the costs of buying, rehabbing the properties, and of course you have operational expenses like insurance, vehicles, payroll, and advertising, and everything else that a normal business does. Your entity structure is going to be an LLC and maybe an S corporation, and in the end, you don't hold any real estate under the entity when you're a fix and flipper. On the other side of the table, you have the buy and hold investor, who's in it for the long term. Their revenues will be the rental revenues that they collect from tenants. The expenses will be typical landlord expenses, where you're going to pay tax, interest, insurance, repairs on all the properties, and the difference is going to be a passive income or a passive loss versus an active income or an active loss. And again, the big difference is buy and hold investors actually pay capital gains when they sell properties for a gain. And they also enjoy depreciation, which is one of the best and most powerful things in the world when it comes to tax savings for real estate investors. That's it for this video. Check out a link below for one of my tax savings guides. It's a quick read and download. You'll be able to use this to save money for years to come. And as always, hit the subscribe button if you're enjoying these videos so we can continue to bring you amazing content to make and keep more money.